Not every break of structure is a reversal. Some breaks are the market collecting fuel before continuing in the original direction. The question is, how do you tell the difference? The answer is context and fuel. Every significant move needs transactions. It needs volume. It needs fuel. Fuel comes from three places: liquidity pools, stop losses and pending orders, clustered at obvious levels. Demand and supply zones, areas of prior significant order injection. Imbalances, fair value gaps that attract price back to fill them. If you are in an efficient range, no demand zones within it, no imbalances, no clear order intent, then the market needs to travel to where the fuel is. It needs to sweep the edges before it can commit to a direction. When sell-side liquidity is reached, thousands of sell orders triggered at once, two things can happen. One, sellers dominate. Price continues lower, genuine reversal. Two, institutional buyers step in. They absorb all the selling. They take the other side. All sellers have been removed. No more sellers left to push price down. Violent reversal. 70 pip wick. Price rockets high. That second outcome, that is absorption. And absorption is how liquidity sweeps, create the largest moves. When you see a potential structure break, ask 5 questions. 1. Is there liquidity or a demand zone below the low? If yes, the break is probably a sweep. 2. Is there imbalance below? Imbalances attract price. That pull explains the dip. 3. Is the current range efficient? No clear demand within, then the market needs to go elsewhere for fuel. 4. What is the macro bias? Still structurally bullish? Then any break below is suspect. Questioning. 5. Wait for the candle to close. A wick beyond the level, body closes inside. That is a sweep. Look the other way. A body closes beyond the level. Potential genuine break. Now it says context. Never enter mid-candle. The candle can reverse before it closes. Wait. Always wait. Once you know it is a sweep, do not trade with the break. Trade against it. The market swept the low. Sell-side liquidity consumed. Imbalance below is now filled. Demand zone reached. Absorption occurred. The candle closes with a large body bullish. Back inside the range. That is your signal. The break was not a reversal. The break was fuel gathering. The fuel has now been collected. The real move, upward, begins. Sometimes the market sweeps the high, then sweeps the low, then sweeps the high again, then the significant sweep. Only then, the real move. It is expanding, collecting fuel from both sides, sweeping highs, sweeping lows, building enough orders to finally commit to direction. During this phase, you cannot trust every break. You can only ask, is this the sweep or the shift? Fuel above, fuel below, nothing efficient in the middle. The market will visit both before it decides. If you want to place a $50 million position into this market, you need liquidity. You need sellers, massive amounts of them, all at one point. When the low is swept, those sellers are all there, forced out of their trades, stop losses triggering. That is when the institution steps in, takes the other side. Every single sell order absorbed, replaced with a buy. The sellers are gone. The buyer is positioned. The wick is 70 pips long. The candle closes strong. That is the fingerprint of absorption. That is how you know. Not every break is a reversal. Ask what is above and below. Ask if the range is efficient. Ask what the macro says. Wait for the candle to close. A wick. Look the other way. A body. Assess the context. Fuel is the answer. Where is the fuel? That is where the market is going. Pull, rain, sweep, or reversal, trade smart, live fully.